our Family of Services leadership team. And as I was mentioning beforehand, they do a really great job at taking kind of maybe some of the things you see in the headlines, some of the things customers might be confused about, some of the things you may be confused about, and they boil them down. They make them very bite-sized and easy to understand. This is obviously being recorded, so you'll receive this as well as the presentation that they cover right after our conversation today. So without further ado, I'm going to share my screen, and I'm going to welcome in our first speaker today, Mr. Craig Garcia. Craig is the president of Capital Partners Mortgage. And if you could all join me like Ryan Pappy is with a nice round of applause for Mr. Craig Garcia. Craig, thank you so much for being here, sir.
Hey, thanks for putting this on, Stephen. Appreciate everybody's time.
You got it. You got it. So, guys, as I mentioned, we're going to show a few questions on the screen. If and when you have questions or comments in addition to these, you're welcome to type them right there in the chat box. I'll be keeping an eye on that today, and you can ask away. So, Craig, if you wouldn't mind, I know there's a lot going on in the mortgage world, obviously, with recent current events. If you could give us an update on kind of what's been going on since the Iran war and what you're seeing with rates and all of that.
So thanks. Yeah, it's interesting. We were on a really good track with rates for quite a while. I mean, rates have been very stable to drifting downwards. And then February 28th happens, and we get into a war with Iran. And so since then, it's definitely changed the outlook for rates, certainly in the short term. So, and the big reason, sometimes people think, hey, there's a war. That is usually causes people to sell stocks and put money into bonds. You'll hear this term, a flight to safety, and sometimes that helps rates. The challenge with this particular war is with the impacts to the oil market, and oil is something that everybody uses, and when the price of oil goes up, then that triggers inflation and inflation concerns, and then that's not inflation is what's bad for rates. So sometimes war can actually help rates. This particular war has not been. So, and the move has been pretty, has happened pretty quick. So you're talking about February 27th, oil was $65, $67 a barrel. By the end of close Friday, it was at $98 a barrel. Now this morning we're getting some good news about maybe a ceasefire for 5 days. That's good. The 10-year Treasury right before the war was below 4%, and now it's at 4.38%. So where we were seeing people get rates under 6 right before this, now they're definitely over 6, maybe even 6.5. Some people getting in the 6.5-ish range, something like that. So the challenge with rates is they usually go down a lot slower than they can go up. So I would say even if the war resolves itself today, I don't think you'll see rates drop quite as fast as they may have gone up during this period of time. But hopefully there'll be some good news as far as everything goes. And now at this point, yeah, the war, the more things look controlled, and then I think rates could potentially come back down. But that's the reason is the oil inflation, higher rates.
Right. That's a great point. Thank you for giving us that current kind of pulse and update on what's happening. Like you said, hopefully that ceasefire will help things for the rate side of it all. So affordability, talking about that as well. What's been going on with recent presidential orders? Could you touch upon that for a minute?
Yeah, so there was some news, some headlines, and this has been something that we've seen kind of on a repeated basis. You see these big headlines about what the administration is trying to do for affordability. So they've come out, there was these 2 executive orders that came out. One was directed towards making mortgages more readily available and more affordable, and the other one had to do with making it easier for builders to build homes. So there's, as far as the one regarding mortgage availability, essentially what it was is it's saying, hey, the CFPB should look at a bunch of things, and it was kind of a directive to, hey, analyze and potentially make some changes. So right now there's nothing that's changed. The one thing that I did look through what the text was, there were some good ideas in there. There was funny enough, there's the points and fees cap. They're saying, hey, you should remove it for small loans. This actually is a helpful thing because, believe it or not, there are certain people that when we go to do a loan for them and the loan is small, there has to be fees that get charged. There's technically some customers that you could look at and say, "Hey, I can't actually do this loan for you because the charges that will be required to charge you for that loan based on your particular set of circumstances, they're not legally viable." So you could have somebody who's qualified to borrow the money. We'd like to lend them the money, but because what we would need to charge is not allowed, you actually couldn't extend the credit to them. So if they change that, that would help some people. It just is not going to help a lot of people in our market because a lot of those types of smaller deals, they just don't exist on the types of properties that are around down here. So I would say I wouldn't be expecting anything big to happen in your that will impact your business out of those executive orders. One of them is supposed to help increase competition amongst lenders. That would help drive costs down. But it's very vague, and I wouldn't really be expecting too much. Certainly nothing in the near term. And as things evolve and they actually make some decisions on what they're going to do, we would certainly update you on what's happening with that. So.
Absolutely. And thank you for that update as well, Greg. And one of the last things that you were going to touch upon is condo rules. I know that the world of condos is kind of ever changing, and last year was a tougher year for condos as well. So what's going on? Are they being relaxed? I've been hearing something about that, but I wanted to get the information from you.
So this is great timing to be here talking to all of you with this just getting released last week. This is some of the biggest news in condos probably since the building structural stuff that we have to look at since all that got enacted a couple of years ago. So there's good news and bad news. So Fannie and Freddie both came out with these rule changes. Some are effective now, and some are effective in the near future. So I'm going to kind of quickly kind of bullet point what that is. We'll probably do a whole standalone session on this that people can listen to because there is a lot to it. So some of the good news, okay? Uh, Insurance requirements got relaxed, specifically regarding actual cash value for roofs. So when you go and get a master insurance, when we look at master insurance policies for condos, one of the things that comes up that we'll see, and we used to see it probably more often than we do now, is we would see condos where they had actual cash value instead of replacement cost value, specifically for the roof. And sometimes it was because, and what does that mean? That means if the roof of the condo got blown off today and they had replacement cost coverage, the insurance policy is going to pay the condo for the amount it would take to put a new roof on there to replace that roof today. Actual cash value is saying, okay, that's a 20-year-old roof. The insurance policy is if the roof gets blown off, we're not going to pay you the amount of money that it would take to put a new roof on. We're just going to pay you what the cash value of a 20-year-old roof is worth today. And then you're going to have to pay the rest, Mr. Condo, project. So Fannie doesn't like that. Freddie doesn't like that until now. And Ryan can confirm this, but there are a lot of condos that they became very difficult to get replacement cost value. They can't even get it on the roof because the roof is over a certain year old. So usually it was like 10 years or sometimes even 5 years old. Insurance companies were not even writing replacement costs for those roofs. So now suddenly the condo would be ineligible for Fannie or Freddie financing. Well, now they're saying, hey, we're going to be okay with cash value policies specifically for the roof. So these condos who couldn't get the replacement cost coverage because they have some older roofs in the project now, and those projects have been ineligible. They will now be eligible. We can use that today. So that is some immediate relief. I wouldn't say we see it every day. It's definitely not that common, but it's not uncommon. And it might even open the door for some condos when they're looking at renewing. They might now be able to look at an actual cash value coverage for the roof, especially if they've got a big savings program that they've been saving up for to cover the roof. Maybe it would help them save some money. So I think that part is very good news for condos. Couple of other things, and I'll go quick. Let's see. a project review waiver, right? So these are
Mhm.
condos that you don't really need a condominium project approval at all. Anytime you find a standalone condo, which is like a freestanding condo, that's very rare, but we don't need a project approval on that. We just have to approve the insurance. Also, condos that before last week, 1 to 4 units, we didn't need a project approval either. We just have to approve the insurance. Now, instead of it being 4 units, it's up to 10 units. So any condominium project, now that only applies if that condo project is got 10 units or less and it's not inside of a master project. If it's inside of a master project, we still have to do a condo approval. But if it's not inside of a master project and you just have an 8 unit condo, we no longer have to do a project approval on that. We just have to approve the insurance. So that's helpful. They're also retiring the owner occupancy requirement in condos. So, and this was only coming into play if somebody was buying an investment property and and now they would look and they were trying to get a full project review. So if they were trying to do just 20% down, they were buying an investment property, they would need to be buying in a project where less than 50% of the people that were living there were tenants. So you couldn't have more than 50% tenants occupying the units in a particular project. They're doing away with that. So
Okay.
that's actually helpful. Um, and the bad news that's coming, okay, is that, and this is pretty significant. August 3rd, Fannie and Freddie are doing away with limited reviews. So, one of them calls it a limited, one of them calls it a streamline. Basically, projects that didn't have reserves are no longer going to be eligible for Fannie or Freddie financing. So that's a big change. That's negative. Now, I tell you what, we've got a lot of different investors, okay? And we do a lot of condos that don't fit for Fannie, that don't fit for Freddie. We still get them closed. We're going to have options for these condos. But it is pretty significant that Fannie and Freddie are not going to do limited reviews anymore. That's a big deal. We will have options. I think they're going to be competitive options. That there's definitely a lot of investors that have tried to fill the space with all the condo problems, and we've got great relationships with very aggressive condo lenders. So I don't want you guys to worry, but you need to know it's coming. The other thing, and I'll wrap, and then we'll be done, is next January, they're increasing the reserve requirements from 10% of what it is today to 15%. So it's going to be
Okay.
harder to get a full approval, full Fannie Mae approval condo. And I will I will respect the time frame for the other guests, and we will put something out. We will do a more in-depth review of all this at a date pretty soon. Thanks.
Yeah, Craig, this is fantastic. And people in the chat were saying, hey, great explanation, Craig. Thank you. They heard it on the news, but they weren't sure how to interpret it. So very, very helpful. And he did it in a very succinct way. Now, before we transition to Mr. Benjamin Jean here with Kai's Property Management, Craig, if you were to leave us with one final golden nugget right now regarding mortgage, what would that be? And as you think of that, my golden nugget would be if you heard something that Craig was talking about and you want to learn more about it, reach out to the Capital Partners Mortgage rep in your office, and they can sit down with you as well and educate you through all of this too. But Craig, what would you like to leave everybody with today?
Oh, I would be getting in front of everybody that you know that owns a condo that's thinking about maybe selling and then or that might be considering selling sometime in the next 12, 24 months. And you might want to kick that timetable up because there's going to be a lot of negative news, I think, coming August when now it's going to be a little harder for some condos to be able to get the type of financing that would allow people to put smaller down payments.
Got it. Great takeaway. Well, thank you for that, Craig. Really appreciate it. And as we mentioned, we'll definitely have Craig back on soon to do a deep dive into a lot of what we heard. And again, make sure to reach out to your Capital Partners Mortgage rep today and this week and really just go through some of what Craig discussed with us if and when you have additional questions on that. So without further ado, Benji Jean, thank you so much for being here with us, sir. Really appreciate it. We know there's a lot going on in the property management world. So the first thing that I wanted to hear from you on is the West Coast expansion. We got some good news there. So over to you,
Yes.
sir.
Yes. I was actually going to yield my time to Craig if he wanted to talk about mortgages for another 15 minutes. But no, we're very excited. I know many of you heard that Myloff Abishan has joined with the Kai's company on the West Coast. With that, We were fortunate enough to have a property management division join our team over there. So for the past 10 years, we've always wanted to expand to the West Coast and be able to offer that service over there. We are now able to do that, which is wonderful. The team there is exceptional. They are seasoned pros in property management. And we are very, very excited to be able to offer that service. So if any of your clients are moving over there or invest over there, we would absolutely love the opportunity to assist them with that.
That's awesome. Great news there. And I know Craig was talking quite a bit about the condos, and we're talking a little bit about thinking about rentals. Can you give us an update from the management side? What's going on with the rental market? What's going on with demand and supply? Are rents
Yeah.
decreasing, increasing? What's going on?
Yeah. So as far as supply and demand goes, what we're seeing is that the mid-range market is getting really hit the most. And so we've seen over the last year and in this coming year, we're going to have 36,000 new units built in the multifamily space, which is disrupting the mid-range rentals. So we've seen a slight decrease in those mid-range rentals, roughly around 3%. So normally what we like to see in the rental world is a 3 to 5% increase year over year, which we've had a great run. Through COVID, with everybody moving here, things have tracked up. With that came an affordability issue, okay, where we used to see and want a 30 to 40% rent to income ratio. We are now seeing people apply with 60, 70% of their income being applied towards rent, which is untenable. That's a big problem. So that mid-range has seen a little bit of a decrease for those renters. Where we're actually seeing increases are in the luxury market still, okay? And really in the workforce housing or the lower tier. And the reason we're seeing an increase in the lower tier is because there's simply not enough supply of it, right? All the buildings that are being built right now are being built in that mid to upper middle range. So your $2,300 to $3,500 a month range, where the affordable housing is just not available in the market. And so we're seeing that increase now, which is only going to put more pressure on the affordability issue.
That makes sense. That's a good overview there too. And with that, talking about what's happening with supply and demand, are they increasing or decreasing? Could you walk us through what you're seeing on the Section 8 changes? What's going on with housing authority, vouchers?
Yeah, this is a really big one that nobody's talking about. What we've seen is there's a proposed cut of 44% from the federal government to the local agencies for Section 8 funding. And what's going to happen and what really has happened is even Palm Beach County Housing Authority about a month ago sent out a notice that they have closed all new applications. In some cases, they're reviewing the amounts. And for partial vouchers, they may be decreasing the amount of money that they apply to the tenant's payment. But right now, as it stands, we have Miami-Dade is frozen for new applicants. Broward County is active, but some funds are actually going to be ending in June 2026. And Palm Beach County, no new vouchers are being issued. There are proposals to only offer Section 8 for a 2-year span. There's a lot going on in this world, but it is going to be have a significant impact when you have such a large volume of renters in the Section 8 program who are now either not going to be able to get vouchers or their voucher is going to be decreased. So this is going to become something to watch. The housing authorities are already commenting and sending out notices saying that, basically be prepared because this is going to be a problem. What you're also going to see is you have a lot of investors who invested in Section 8 properties because they were guaranteed rent each month, right? that market is ultimately going to take a hit on an investment standpoint because investors are going to look at that as not as a secure investment as they once did. Now, long term, do I think this pans out? Yes. I think that ultimately budgets get reworked, funding gets reworked. Section 8 is not going anywhere. But in the short term, if you're working with tenants who have Section 8 vouchers, if you're working for owners who own Section 8 housing properties, this is something that you'll want to be educated on so that you can clearly communicate to them, and they may not know what's going on.
Yeah, absolutely. That's a great point, Benji, and being that source of the information and making sure you're educated enough and proactive to make sure that everybody's aware of it. Now, I'm going to also ask you, Benji, for your final kind of golden takeaway, golden nugget. And right before I get your answer there, you were mentioning the great team over in Cape Coral with Myloff Abishon. I want to give a big shout out to Jeff Myloff and Gary Abishon for being on this call right now as well. Really a great team over there. And Benji, thank you for acknowledging that as well. So,
yeah, they are wonderful. If you haven't met them yet, make a point to do that. They are very much, ingrained in the culture already, and we're very fortunate to have them.
absolutely. All right. So what's your golden takeaway here for
Well, my
property
one
management?
takeaway is you really missed your opportunity. You should be like a sportscaster or like, you have that voice, you have the my takeaway is this. It has nothing to do with the Section 8 or the rents. But what it really has to do is understanding what your role is as a real estate agent. We're starting again, as markets shift, as things get a little bit tighter, real estate agents start to do things that are outside the scope of their job description, right? I always talk about being, we want to be super servicers. We want to help our clients with everything. Oftentimes, we don't take into account what that means from a liability perspective on our side as realtors. And so please, make sure that you understand that your job is to transact real estate. Okay. If you start getting into the property management side of things, I can assure you that the legal side of things will follow. We're starting to see an uptick in lawsuits coming through with agents who are doing property management services. And when they sue you, they also sue Kai. So I will ultimately get the call from Mike that says, wow, we got another lawsuit, can you help me out? So please just make sure that you protect yourself. We're here as a resource for you. So if you have questions, if you have concerns, if your customers need help with management, we really want to be there to help you.
Great point, Benji. And you thought you were about to take a step out here, but I got 3 questions that just came through for you, if you don't mind.
Looks like I have 5 minutes left on my time. Let's go.
All right, perfect. So first one there is what questions should we be asking caseworkers?
Caseworkers, yes. So if you are directly involved with the caseworker, you're going to want to ask if their voucher is still going to, if their voucher will expire and if it will be renewed. You'll want to ask them if there's going to be a decrease. So, one of the things we typically do for our Section 8 rentals is each year we get a letter that says, would you like to renew this tenant? And if so, is there an increase, right? And of course, all of my owners are like, you don't have to ask me twice. We're going to increase. Now we've actually asked for increases and they've made it explicitly clear that they are not increasing any of the rents, at least the voucher portion. So you'll want to ask that. But those are the main questions that you really want to ask the caseworkers.
Okay, that's great. Now, before I jump into the next 2 questions, I did want to highlight 3 special guests, Benji, that are waiting to talk to you. We have Mike Pappas, Jeff Mylock, and Gary Abishon.
Yeah, I'm here in Cape Coral. He mentioned Cape Coral, and wanted to say hi. If anybody's maybe get some feedback to us, maybe.
We got a little trouble with the mic, Mike.
Yeah. So I was just going to say, if you're looking for value, you want to drive over to Cape Coral and see the great deals. Gary's one of the biggest builders. Steve and I would ask you to interview him for a special session later on. But they are the waterfront gurus in Cape Coral. Great value, $500,000 price of a listing I just heard on the waterfront, $1 million, $1.5 million. So maybe want to come over and find out about it.
Love that. Thank you, Mike. Thank you, Gary and Jeff as well. Really appreciate that. And Gary, we'll absolutely have you on a session to educate all of us about custom builds, and that's exciting. So Benji, back to you with two questions, and then we'll let you go. First is, can you please clarify for new investment purchasers in Miami-Dade County, is there no Section 8?
Well, Section 8 still exists, but at this time, they're not accepting new applications to the voucher program, right? I believe there are about 5,000 people on the waiting list, and I think they've actually closed the waiting list as well.
Got it. Okay, thank you for that. Two more questions came through. The first is, can they reduce an already approved voucher?
Yes, they absolutely can. So there are two types of vouchers. There's a full voucher, which is the entirety of the rental amount. And most commonly, there are partial vouchers where the housing authority will pay typically around 70 to 75% of the rent, and the tenant is responsible for the remainder. That is really where they can make the most changes. They can say, well, now we're only going to pay 60% or 55%. The tenant, based upon their income, is going to have to be responsible for the remainder. That's a way that they can keep the voucher system rolling without, and also still pay some of the rent, but offload some of that deficit that they have from the government.
Got it. That makes sense. Thank you for that clarification. And our last question for you, Benji, is, can you accept Section 8 at the minimum and charge the difference? $2,900 a voucher and rent is $3,500.
Yeah, so look, at the end of the day, the housing authority is going to issue a voucher, right? You can say that if rent is $2,000 a month, if their Section 8 voucher is only giving them $1,500 and you qualify them to be able to pay the $500 difference, sure, that there's no problem with that.
Got it. That makes sense. Now, Benji, I told you it was your last question. It's not. We had another one come through, and it seems like we're going to have you back on for your own session.
No problem.
So this will be the last one, just for respect of your time as well. But when a property that is Section 8 approved is purchased by a new investor, does Section 8 approval remain in place? And we also just got another question, so stick around, Benji.
Yeah, so maybe we'll do another one after. But yes, the lease. So what'll happen is that voucher is in place. The lease is in place. What'll happen is upon renewal, Section 8 will likely come and do an inspection of the property in order to continue the qualification. We do inspections every year with Section 8, continue the qualifications. But if there is a new owner, that's not an issue. What'll happen is they would change the payment details with their Section 8 caseworker and with Section 8, where those funds will now directly deposit to the new owner.
Got it. All right. Well, thank you, Benji, for all that information. Thank you for sticking around as well. Like we've discussed, it seems like we're going to have all FOS leaders again on for your own individual segments. But thank you so much, Benji. And if you guys haven't ever connected with Benji Jean or his team at Kai's Property Management, make sure to do that this week. Just reach out to them, get connected. You can ask, as you're hearing Benji on the spot here, you can ask any question and they'll walk you through it and educate you in the aligned fashion. So again, thank you so much, Benji.
My pleasure. Thank you.
You got it. All right. Now, next up, we have Mr. Raul Molina. Now, Mr. Raul Molina is the president of Home Partners Title, and he's going to walk us through quite a few things today. So if you could, I know we've got something hot off the press, Raul. We were talking about this beforehand. What's going on with FinCEN, anti-money laundering rule, different updates in Texas? Walk us through this.
Yeah, so since March 1st, it's been a whirlwind for the title industry with the new ruling that came out regarding the FinCEN. It's the anti-money laundering rule from the Treasury Department, where we were required to report buyer information that extended to trusts and entities with no price threshold on all cash deals or deals that were not financed traditionally. So that was the big news March 1st. We were switching over to the new rule. We were now having to collect buyer and seller information on all deals that were non-traditionally financed, that where the buyer was an entity, an LLC, a corporation, or a trust. And that meant that the agents were having to be proactive and, of course, let their customers know that this information is going to be required by the title company, which the new rule made the title company legally responsible for collecting this information and submitting it to the Treasury Department, the FinCEN portal, prior to closing. And again, it eliminated all price threshold. So now on Friday, we just received a ruling in a Texas federal court where a judge struck down the Treasury Department FinCEN rule, saying that it overreaches and doesn't specifically state how the new rule is really going to affect the way that real estate is acquired, and that it's not as suspicious just because it's over $300,000 or it's under $300,000. So it basically said it was too vague and too broad, stating that they did not really specify how it is suspicious for a individual purchasing in a trust or an entity, adds to the suspicion that there could be money laundering there. So it was struck down for now. And what we are expecting is for it to be appealed. So for now, we are reverting back to the old FinCEN rule, which was the price threshold of $300,000 or more. And we no longer have to collect information on the seller, it's on the buyer. So that is right now what we're reverting back to until it is either appealed. And what we are expecting is that it will be appealed, and there might be further ruling after the appeal that may narrow the scope of the requirement, or maybe adjust it in some way. But we do see that moving forward, it is clear that there is going to be some kind of transparency requirement that is going to continue to be enforced by FinCEN. So for right now, it's just more unclarity on the matter. All we know is that we need to revert back to what it previously was before March 1st, which we were all used to already. Anything over $300,000 where the buyer is an entity, we are reporting to FinCEN.
Got it. That makes sense. And that's a great point as well. And as you've heard me say with other leadership teams here today, is if you're not 100% confident in what Raul was just explaining, make sure to reach out to your home partner's title rep today in this week and have this conversation, because they're obviously on the cutting edge. You're hearing from Raul today, and they'll be able to walk you through that. So that's great. Now, Raul, as we shift gears a little bit, there's something that nobody likes to talk about because it's uncomfortable and we try to avoid it at all costs, but it's necessary to be aware of it and proactive. And that, of course, is fraud and wire scams in real estate transactions. So if you could walk us through what's going on, are these things on the rise? What can associates do to be proactive and really be prepared to hopefully catch these things before anything were to happen?
Right. So one thing in the title industry that has not changed is the fact that it is a hotbed for fraud, and in the real estate world in general. So yes, wire fraud and seller impersonation fraud and payoff fraud continue to rise. All three of those. Most people are familiar with the wire fraud part, but the seller impersonation fraud is also on rise, and so is payoff fraud. So with wire fraud is when the wire instructions are intercepted, and the money basically, instead of going to the intended escrow account of the title company, goes to a fraudster's account because the buyer is sent wire instructions that are fake. They're usually told that the wire instructions have changed, and those wire instructions and that notification comes from an email that looks like it's coming from the title company or someone that they trust, like a real estate agent. Usually that happens when a hacker is able to hack a realtor's email and copy the communication and the headers of the emails, the communication between the title company and the buyer, and they construct fake instructions and send a fake notification to the buyer to send the money to another account. And they're usually tracking the transaction. They know exactly when it's coming time to closing, and they'll put some urgency on it, saying that if they don't receive the funds today, that it may delay the closing. So then the buyer will act on those. So what Home Partners Title does is to avoid all that, we use a secure portal, and our wire instructions are on that portal. So we send a secure link to the buyer that gives them access to create their own account and to securely log in and obtain the wire instructions. So if they ever get an email saying that the wire instructions have changed, they could rest assured that it's not coming from us, because we don't send wire instructions via email. But even if they were unsure, they can always log back into their portal and see the wire instructions and see that they have not changed. Okay.
Got it.
So what we urge the agents is to inform your customers to never trust when wire instructions are being changed, or to trust an email that says that the account is now different for whatever reason. They come across very, very believable. And we used to be able to rely previously on bad grammar, but now with AI, the grammar on these things is much better than if somebody actually really put it together in a real situation. So we can't rely on those things anymore. You cannot rely on the information that is being provided in the email itself either to verify the wire instructions. So for example, we had a case in Rhode Island where a title company, it was $4 million wire fraud that they got duped out of. And it was because the title company itself called the numbers on the wire instructions to verify if the wire instructions were correct. So now they have multi-layer fraudsters. It's not just the person sending the email, but they have people sitting behind phones, and they'll put a telephone number or an email address on the actual wire instructions to verify. And when they call that number, the person that picks up is also in on the scheme, and they will say that yes, it's correct. They'll pretend to be an attorney for the seller or for the buyer. They'll pretend to be a financial advisor. So never trust the information that's actually on the email that you're receiving to verify. Do an independent verification. Look them up, do a Google search, call a number that you're familiar in speaking with your processor or your closer to verify. Don't use any information that's provided within the email, because it's all deemed to be part of the fraud.
Yeah, that's a great point, Raul.
And then seller impersonation, very, very important to understand that the agent play a key role there. There are going to be red flags if the seller does not want to meet with you in person, or speak to you on the phone, or do a video conference call. Even with speaking on the phone and video conference calls nowadays with AI and those deep fakes, you have to be very careful. But if you see red flags where the seller does not want to communicate in a traditional way, ask the questions and be very suspicious, because their seller impersonation fraud is also on the rise, and they are pretending to be the seller. They'll go into contract. Once they receive the proceeds, you'll never hear from them again. So one of the things that we suggest is that you do a little bit of research. And if you do obtain a listing from a seller that you have some questions about or suspicion, go to public records, take a look at where the tax bill is going, the address where the tax bill goes. If the taxes are current, go ahead and send an email, a letter saying thank you for working with us on this listing. We're looking forward to selling your property, and send it to the address that is on the tax roll. If the individual that receives that is not selling their home, they're going to call you very, very quickly. Of course, leave the contact information on the letter where they could call you if they have any questions or anything like that, and then they'll reach out to you. That's what we do on our end. Once we receive, for example, if it's vacant land and it's non-owner occupied, we will send a letter via US mail to the address where the tax rolls are, where the tax bill is being sent based on the tax rolls. And it'll have a PIN on it. And unless they are able to verify that PIN, we will not proceed with that until we have further information that proves that they are the seller. Okay. If they're showing up to the closing, that's different. There's different ways to bring down the suspicions. But if all red flags point in that direction and they can't verify the PIN, then we won't proceed with the transaction.
Got it. That makes sense, Raul. And to your point as well, it's funny, I say it all the time. Technology is great when it works, but in this case, we can't assume that everything we're receiving is going to be accurate. We have to make sure we've done that due diligence and that we're looking further into it to avoid these situations. Now, I have a few questions that came in for you as well. There's one thing that I want to note. This is separate, not talking about fraud or wire scans, things of that nature, but when you are working on winning a listing, I highly recommend for all the associates watching this live, listening to the recording, to use the seller net sheet that Home Partners Title provides. I called Raul last week on a personal matter for this, and he's like, yeah, it's right here. Here's where you find it. Within 30 seconds, I had multiple seller net sheets. It does all the calculations for you. It's a very thorough program, and it's at no cost to you, the associates, company paid. It's really a huge item of value. So if you don't know what that is, a seller net sheet, make sure to go find out what that is today, either by contacting your title rep at Home Partners Title or talking to your concierge or your manager in your office. It is such a valuable tool, and I really believe it'll help you win more listings. But that was just a side note. Wanted to give you guys props for that, Raul. Thank you again for answering promptly on that. So our first question, when a CFP is sending a large wire of $1 million to Home Partners Title, are there any additional security measures instituted?
So not necessarily. What we take a look at is to make sure that everything is in line with what the information that we have. So the more information we have to verify and make sure that those things are all aligned, the better. So the systems that we have in place are the same for if it's $5,000 that's coming in to if it's $1 million that's coming in, because it's all secured in the same way. The amount of money does not make it more susceptible in the sense of the way that our equipment works.
Got it. Okay, that's good to know. That's good to know. Now, another one that came in here is I have a buyer closing with private money, and the title is asking if the lender has a FinCEN money laundering policy. And the question here is, so they don't need that right now, or do they?
Well, it depends on the price threshold. If the private lender is not a traditional, if they don't have the anti-money laundering, it could be in that vague area where the title company, based on what their underwriters tell them, they may want to go ahead and mitigate that risk and request it anyways.
Got it.
That's
That makes
the
sense.
problem, is that there's so much uncertainty right now. There isn't a
Yeah.
clear rule. So title companies are going to be erring in the side of caution. And if there is a doubt, they're going to go with collecting the information and submitting it.
That makes sense. Yeah, absolutely. Well, thank you all for that, Raul. And someone said as well, great information closing a remote cash deal this week with Home Partners Title. So that's always exciting to hear.
Yep.
Now, Raul, if you were to leave us with one final golden nugget before we bring in our final speaker of the morning, what would that golden nugget be when we're thinking about title?
Well, two things. Actually, I want to go ahead and one thing that wasn't in our slides, I want to let everyone know that Home Partners Title, as part of the Myloff Abishan deal, is also now present in the West Coast.
Nice.
In the Myloff Abishan building there, we have actual presence. We have 2 Home Partners employees now working there. So we're very happy to be a part of that deal as well, and a part of the Myloff Abishan family there, and the new guys partnership. So thank you guys for the opportunity, and we look forward to working with you and growing our business in the West Coast. So if you have West Coast deals, definitely you can now send them to Home Partners so that you could get that great service there in the West Coast as well. And like I said, we do have physical presence there. We do have 2 employees, one of which has been a part of the Myloff Abishan team for many, many years, and has been in the industry for over 30 years as a closer. So you'll be in good hands there. The other thing is the golden nugget would be, use us as a resource. Always know that you have a subject matter expert as part of your team in the title world. No matter whether we have your file or not, before you have a contract, after you have a contract, or even if you have a contract with another title company. If you have a doubt on something or you want a second opinion, if you need a pencil search, you need to look into something, verify a trust, verify a POA, let us know. Our title team is ready and available to help you. We could pull public records. We could take a look at things for you. We could look at a warranty deed, let you know who your seller should be on the contract. We could tell you if FinCEN applies or if it doesn't. We could tell you if FERPTA applies or if it doesn't. Those are the two F words in the title industry, FERPTA and FinCEN. So we could definitely help you with those. Give us a call. Do not hesitate. You could sell yourself to your customers as having subject matter experts, not just in title, but obviously in mortgage, property management, and we're going to hear from Ryan too in insurance. We are part of your team, and you can always use us as resources to help you grow your business.
Love that. Thank you, Raul, so much. Really appreciate all that information today. And again, for anybody who has further questions on title, feel free to reach out to Raul, your title rep in the office. They're in Myloff Abishan, physically present, which is really exciting to hear as well. And again, Raul, thank you for having such an amazing team and amazing resources for our associates here. So without further ado, we are going to bring in Mr. Ryan Pappy. Ryan is the president of Kai's Insurance. And Ryan, welcome to the stage. Thank you so much for joining us, sir.
Hey, Stephen, how are you doing today?
I'm doing great. Thanks. How are you?
Very good, thank you.
Good. Love to hear it. So we're going to dive right into things here, Ryan. First is really obviously a hot button topic for everybody, and that's just getting a market update from you. I know the past few years, insurance has been, we'll call it exciting, and I want to hear from you what's going on, what you guys are seeing.
Okay, all right. Well, good morning, everybody. So I'm going to break it up into two groups. One is essentially all the policies that people that currently have. So who your current homeowners that are looking to sell that already own the property, they are experiencing anywhere from 10 to 20% reductions in premium based upon where they are located, from close to the coast, which county they're located in. That's what they can expect to see here. That's what they're currently getting. To the new buyer, you're not necessarily seeing a price decrease because they didn't have that cost before, but we are seeing significantly more competitive rates across the board. The reason for that is because of the tort reform that was made only a few years ago, which has made it significant different in the market, which has made it where that now you can have private companies, because before it was essentially just citizens during that tough period. Private companies can now win again. They can now be profitable, they can underwrite, and they don't have the fear of getting sued for water claims. So what you're seeing is a ton of private companies coming into the market. What they're doing is taking out citizens policies that were on the books, not necessarily writing new business. So the ones that your new clients are going to be getting quotes from are the carriers that have been, in play for quite a long period of time. They just kind of gotten off their hands and they're now back in business. Some of them may have renamed the company in order to get more capacity, as insurance carriers have been known to do. But we are seeing a definitely, as long as I've been here and you guys have been listening to me, we are in the best position as a consumer to buy insurance that we have been in probably 2 decades. And you're probably seeing higher rates today than you'll see for another 3, 4, 5 years. Because what you have coupled with the tort reform, which has decreased claims by 70%. So if we said, hey, it's decreased claims by 70%, those price reductions, are realistic over the long term. But what you're having is that, and it's also mixing in with AI, right? So one of the things that AI will be a benefit to all of us, and I know it's a scary topic, is it should help mitigate risk. And as it continues to mitigate risk, and as it continues to give the carrier more information on who their insured may be, and how they can mitigate claims or keep losses to a minimum, we're going to see continuing dropping rates. That's just my belief. Now, what you could say is what happens if a storm comes? Well, the storm is actually a different, insurance pricing comes from two different ways. One regular claims, one windstorm. The windstorm market is backed up by the reinsurance market. The reinsurance market is doing pretty well right now. So the carriers are actually seeing reductions in those rates. And, when they say a perfect storm, it's kind of the opposite of that. So that's the good news. Now, what's not changing is still the strict rules, right? The roof still needs to be clean. The 4-point inspection needs to be clean. The wind mitigation report, which they're going to be coming out with a new form. I'll mention that in a second. But basically, all those things they still stand, right? You're not going to be able to slide in a property that's not insurable in this market. But if you do have something that is solid, the inspections are complete and they're there, then you're going to be seeing a lot more competitiveness, which ultimately will continue to drive down price. The last and to be honest with you, I usually say last place to feel this would be Miami, but Miami's also had the highest rate increases, so they may actually see a biggest slash in rates as in other areas. So super important that we get that word out. Insurance for a long time was like, kind of like the grenade in the foxhole. Like you didn't want to find out about it, and at the very end of the deal, it could kill the deal. But today is very much the opposite.
It's good to hear. Good to hear. Thank you for that, Ryan. Really appreciate those updates. And right along that same conversation, could you walk us through the quoting process and expectations? I know you're talking about some of the eligibility and things like that, the roof, the 4-point wind mitigation, but walk us through this.
Yeah, absolutely. So obviously, there's two different ways we receive quotes from you guys. First one would be if you send us directly to our representative, which we highly recommend, because that's going to be the earliest in the process, and the earlier, the better in almost every situation. The second one is we would receive it through transaction desk, and then you would be receiving quotes from us like many of you do on the properties that you have. The thing that I wanted to mention is specifically is, well, one thing which is just a side note, important, but not necessarily to your question, is the windstorm mitigation form will be changing. I'm sure you'll hear about it from your inspector. It is very important that you get on the same page. Basically, anything after April 1st needs to be on a new form for some of the carriers. But if somebody's closing April 10th and they've already done the inspection, that inspection is still good for 5 years. So don't worry about that portion of it. But the part or then that I wanted to touch on is once we get the quote, once we get the final numbers, we still have to run insurance scoring, which is a soft tap on their credit, and we still have to run claims reporting. The claims will follow the client from any state that they've been in. So, we have a lot of people that move to Florida from other states. Unfortunately, that does not disappear. And it will be checking for claims on the property. So just like I mentioned before, it's a more competitive market, but you still need to meet the guidelines. The first one was about the property. The second one is about claims. So that's still very important. And that's why we stress to get involved earlier in the process, to work with us so that we can then check all those boxes off as soon as possible so that you can have a clean closing.
Yeah, that's great, Ryan. And if you haven't worked with their team yet, again, make sure to contact them this week and just get an understanding of the process. They're always so smooth and efficient. I use them personally myself. Nick Varsi, he's on this. I contact him probably too much when it comes to different questions, but they're always there and they're doing a great job. Now, the next one here, Ryan, is about key underwriting trends. You've obviously been explaining that here. Is there anything else you want to add on before we shift into your last key point?
No, I would essentially say that the most important thing is still going to be the roof. The roof
Yeah.
is really the driver. What the carriers are looking for is 5 years life expectancy. In many cases, that can go above 20 years, but basically for most of the carriers, they set that 20-year mark. So that's something that's very important to always be looking at. That's again, number one driver on price. The second thing is going to be water coverage limitations. A lot of times you'll see that quoted, we'll send that back on a quote because that can reduce price. So that gets price, water damage maybe to 10,000. I believe like It's a ridiculously high percentage of water claims that actually are under 10,000. So sometimes that's a good bet. But those are really the two things that we're starting to see. We're also starting to see people save on essentially where they had a 2% deductible, then they moved to a 5 to offset premium. Now they're going back to a 2%. All those trends are happening, and we provide all those options to each and every one of your clients, whether it's at renewal or whether it's new business.
Got it. Thank you for that, Ryan. And speaking of water and things of that nature, the last part here is all about flood insurance. So, can you
Yeah.
give us an update on any changes, considerations people should think of?
Yeah, so the biggest thing I want to get across is Citizens. If you're buying, if the property is with Citizens and it's over 400,000 replacement costs, they will mandate flood insurance. And so that a lot of the times when we deal with clients that, everybody in Florida is in a flood zone. Certain homes are in high risk flood zones. So then in order to do the bank to be happy, you have to get flood insurance. Citizens kind of washed that, said, hey, we're not good at planning, with these flood maps. So you have to get it. It's also a way to encourage people and to entice them into the private market. So I just want to make sure that everybody is aware of that. That is something that we don't make the rules on, Citizens does. And to be completely honest, I think most carriers will eventually go that route, just because when it becomes a claim after a hurricane and it's like, what did the damage, the wind or all the water? And they fight about that. So I think that there will be some movement in the market and clarity there. But for the time being, that's where we stand. But I'll tell you, because that sounds a little dramatic, but but Florida also does very good against floods. Where our flood pricing is not as high as many places in the country that you would doubt even have any real flood issues. So never let flood insurance scare you unless you get out of the car, walk down the driveway, walk down steps to walk into a front door. So we can quote those in 2 seconds now if you have any issues with those. A year or so ago, we'd take an elevation certificate. Now it's just the address, and we can shoot out a flood quote to you guys immediately. Please don't wait for a deal to be done to reach out to us. Our value that we hope to provide to you guys is during the shopping process or selling process for your client. We want to be a very good access place for your information and continue to build that relationship with you. So please don't hesitate to contact us at any time.
Thank you for that, Ryan. I like what you said too. Don't worry about it unless you're walking downstairs or down a driveway. That's a good point, good way to think about it. Now, we had a few questions coming for you as well, Ryan, if you don't mind. And for everybody watching, I know we're going to go a little bit over the hour. So if you need to jump off, we are completely understanding of that. But we're probably going to go just a few minutes over. So the first question here is, what happens if a roof has less than 5 years of life left?
Then there's two different. One is you can go to Citizens. You have to have a contract for the roof, and it has to start the day of the closing, and it has to be completed through 90 days. So there is a process for that. We have to get involved early because it needs to be approved. There will be a time period of a week or two where everybody's on pins and needles waiting for that approval. But overall, we are seeing success when we put those through. But that would only be with Citizens. Nobody else would take it. Now, having said that, the best way for you to look at it from a realtor point of view is, because this is where you see a lot of emotions come in, is from the roof. Hey, maybe we don't need a whole $30,000 new roof. Maybe we need to fix a few tiles, patch a few holes, and then that roof has 5 years life expectancy. In most cases, that's what happens. So if you do get an inspection back and there's issues with the roof, work with us. We can come up with the best solution, get with the right inspector, and go ahead and make it so that it can pass inspection without having to get a whole new roof.
Okay, great point there, Ryan. Now, the next question on our list here is, you were talking about, hey, that report stays with you because a lot of people move from different states. The question is, how long does the information stay on a customer's report?
It stays forever, but it really affects you from an underwriting point of view for 3 to 5 years, depending on the carrier.
Got it. Okay, that makes sense. Next was, what's the average cost for flood insurance?
Oh, that's almost impossible. That's impossible. You got moving pricing and in the value of the home. different places. I can tell you that, if somebody is not in a flood zone, right? And it's a regular home and they just want to say, I want to make sure I have flood insurance to cover myself, they can probably get it somewhere close to around, $1,000 or so, depending
Okay.
on, but that would be a 4-bedroom house. If they send me the address who asked the question, we will get you the exact answer in a very short amount of time.
Awesome. That's really helpful. Thank you for that, Ryan. And Carolyn Bonilla in the chat said it changed to 30 days. Roof needs to be completed within 30 days.
Oh, yeah.
And then just a few thank yous, great information as well. But those are all the questions, Ryan. So if you were to leave us with one final golden nugget when we're thinking about insurance, what would that final takeaway be today?
I would say that this is one of those areas where actually the public and the lawmakers work together and we have gotten some success. Because without a lot of the changes that we made, it'd be a lot harder to sell homes, buy homes, and everything is set up correctly from a structural standpoint. We just need to make sure that we're always writing good business and still following the standards. But we have sunnier days ahead of us, certainly, than behind us.
I like that. That's a great final takeaway for us, Ryan. And again, for everyone watching and listening, if you could join me in a nice round of applause for our family of services team here. They've done a fantastic job. I told you it'd be a value-packed hour, and it absolutely has been a value-packed hour plus. We could keep going on for another 2 hours or so, but out of respect for your time and theirs, we will call it here. But thank you all so much from our leadership team, really, for taking the time to always be available to educate us on what's happening, and also not just to give the information, but to walk the walk with our associates, to be there every step of the way. We really appreciate all of you for what you do, and for all the reps as well in the offices and around the whole state of Florida. Thank you all for being such professionals and always being available to help with any kind of question, any kind of deal, any kind of situation. You guys really are heroes of those deals. So thank you all so much for everyone. Again, have a productive week, and we look forward to seeing you next week on another Steven session. Thank you all so much. Have a wonderful day. We'll talk soon.
Okay.